All right, Shanna. Ever so often you see a headline about a bank failing somewhere in the United States.
It's a terrible, terrible feeling, and it's an unsettling feeling. And you see the news, and even though it might be happening far away from where we are, it's just natural to have that little unsettling feeling of, wait a minute, is my money safe?
Oh, it's a fundamental question. And it's one that we take incredibly serious here at First Century because that trust is the foundation of who we are.
And it's the trust of knowing your bank is going to take care of you. And back in our very first episode, we talked about that. We talked about the deep history of First Century Bank and how being a Tennessee tradition since 1894 means we've seen a lot.
Mm-hmm.
Our bank was built to be a stable cornerstone for our communities, and it proved that by weathering the Great Depression when many other banks failed.
Absolutely. That local century-long history of stability is the very first layer that our trust is built on. And today, we want to talk about the additional layer of protection that exists for every single one of our customers.
And you're talking about that very critical government-backed safety net designed to give everyone complete peace of mind. And I know sometimes when we say government, you don't feel real great about that, but this is very true, that it is a government-backed safety net. And we're going to pull that curtain back on it today to show you that your money really is incredibly safe.
Welcome back to Making Sense of Your Sense. I'm Daniel Hill.
And I'm Shanna Browning. And today, we're going to tackle one of the most important and reassuring topics in all of banking, FDIC insurance.
Man, we often see that little gold and black FDIC logo on our door or at the bottom of our website. But today, we're going to break down what it actually means for your wallet, what is covered, and just as importantly, what isn't.
All right, Daniel, let's start back kind of at the very beginning here. When we see the acronym FDIC, what does it actually stand for?
Well, FDIC stands for Federal Deposit Insurance Corporation. It's an independent, that's very important, it's an independent agency of the United States government. And its entire mission is to maintain stability and public confidence in the nation's financial system.
But we know it's also not been around forever.
Right.
So I know our bank's history since 1894 that there was a time before that protection even existed. So why was the FDIC created in the first place?
Well, Shanna, that goes back to the Great Depression. In the late 1920s and early 1930s, the country experienced a massive wave of bank failures. Thousands of banks closed their doors.
And my grandparents were part of that generation. And so in those days, if a bank failed, well, the depositor's money was just gone.
Wow.
Like just gone. And people lost their entire life savings overnight.
And it created widespread panic. The fear of a bank failing would cause bank runs where everyone would rush to withdraw their cash at the same time, which in turn would cause even a healthy bank to fail. It was a crisis of confidence.
And a hard lesson to learn because the government stepped in to stop the cycle and they wanted to restore that trust.
Precisely. And in 1933, Congress created the FDIC, the Federal Deposit Insurance Corporation. The promise was simple and powerful. If your bank fails, the government guarantees that you will get your insured deposits back. And Shanna, the track record is incredible. Since 1933, no depositor has ever lost a single penny of FDIC insured funds.
Now, that is a good track record. No question about that. So let's get specific on that. When we say insured deposits, what types of accounts are we actually talking about?
Well, as the security officer here and the marketing coordinator, I do get the question a lot. The FDIC insures deposit products that form the core of most people's financial lives. This includes your checking accounts, savings accounts, money market deposit accounts, and your certificate of deposits.
Okay. So basically the cash you have deposited at the bank for safekeeping and pretty much daily use. It even covers things like cashier's checks or money orders issued by the bank, right?
That is correct. Now, what's just as important of what is not covered. This can be a point of confusion.
And so I think people often assume everything at the bank is covered, but that's just not the case for investment products.
Exactly. And this is a critical distinction. FDIC insurance does not cover investment products, even if you buy them at a bank location. This includes stocks, bonds, mutual funds, annuities, life insurance policies, and more recently, crypto assets.
And so that's what we're talking about when we say investment products, right? Okay. All right. So because these products have investment risk, the FDIC's role is to protect your deposits from the risk of the bank itself failing you, but it's not to protect you from market fluctuations.
Spot on.
Got it.
It's also worth noting the physical contents of a safe deposit box are not FDIC insured. Those are protected by our physical security, but they aren't covered and considered deposits.
Gotcha. So pretty crystal clear.
Hey everyone, it's Daniel Hill from First Century Bank. If you've enjoyed listening to Making Sense of Your Sense, and you found our tips helpful for your financial journey, I want to ask you a quick favor. Please take a moment right now to hit that subscribe or follow button on your favorite podcast app. It's the best way to make sure you never miss an episode, and it helps other people in our community find the show. We also really want to hear from you. Do you have a question we haven't answered yet, or just want to let us know what you think of the podcast? If you're listening on Spotify, you can leave us a comment directly on the episode page, or you can always send us an email at podcast@fcbtn.com. We're building this show for you, and your feedback helps us make it even better. Thanks so much for listening and for being part of this journey with us.
So let's go to that lovely number that everyone knows when we talk about FDIC insurance. How much is actually covered?
Well, the standard FDIC insurance amount is $250,000 per depositor, per insured bank for each account ownership category.
Okay, so let's break that down. Per depositor means per person. So if I have $100,000 in a savings account in my name alone, am I fully insured?
Correct. Now, per insured bank is also key. If you have accounts at two different banks, your coverage is separate in each. You'd have up to $250,000 in protection at both.
And that last part, for each account ownership category, is where I think people get actually even more coverage at a single bank. Can you explain that, Daniel?
Absolutely. The ownership category refers to how the account is titled. Most common are single accounts, joint accounts, and certain retirement accounts like IRAs.
Let's use this as an example. Say a husband and wife have a joint checking account at First Century Bank. How much of that is insured?
In a joint account, each co-owner is insured for up to $250,000. So for a husband and a wife with one joint account, the account insured is a total of $500,000.
Oh, wow. I like that better than 50.
Mm-hmm.
So, also, and what if they also have their own individual savings account at the same bank?
That's where the ownership category rule comes in.
Okay.
The husband's single savings account is a separate category, so it's insured for up to $250,000. The wife's single account is also in a separate category, insured for another $250,000.
Okay. So that couple at our one bank could easily have over $1 million in insured deposits just by structuring their accounts correctly.
That is a powerful level of protection that I think a lot of people aren't aware of. And as we'll discuss in our tip, the FDIC has tools to help you verify this for your specific situation.
Okay, I feel better. I mean, I really feel better knowing that my money is safe. So now it's going to be time to put this knowledge to work with your this week's actionable tip.
Your action item for this week is to know your coverage. You don't have to guess about your FDIC insurance. You can get a definitive answer directly from the source.
The FDIC has a fantastic, easy-to-use online tool called the Electronic Deposit Insurance Estimator, or EDIE. EDIE. Your task this week is to go to the official FDIC website at fdic.gov and find the EDIE tool.
We'll put the link in our show notes so you can find it easily. But this tool will walk you through a simple process. You'll input your bank, your account types, whether it's checking, joint savings, IRA, and the balances in those accounts.
So in about 90 seconds, the EDIE tool will give you a detailed report showing you that your funds are fully insured. And I'll be honest with you, it's the ultimate peace of mind.
The goal this week is to replace any lingering financial anxiety with certainty. Take 2 minutes, use the EDIE tool, and know for a fact that your hard-earned money is safe.
And that's what this is all about, right? Getting answers from the people who know these topics inside and out.
Speaking of which, be sure to join us next week as we continue that theme. We'll be talking about a topic that can be a source of stress for many, overdrafts. And we'll be joined by another one of our in-house experts, Amy Earle, to break it all down.
And you really don't want to miss her insights. So subscribe wherever you listen to your podcast. And thanks for tuning in. I'm Shanna Browning.
And I'm Daniel Hill. Go out and make some sense of your sense.